Welcome everybody to yet another Take Back Control Tuesday. And I want to thank you all for joining us. Now, I can't tell you what the outcome is going to be for each of you, but what I can tell you is what you're about to learn absolutely can change your financial future. If you're here, you're probably ready for change. And what you're going to learn and the insights you're going to take out of this will help you get there. So if the prospect of taking back control of your money isn't enough to keep you glued to this screen right here for the next 90 minutes, then I think we really need to reassess our priorities. And tonight we have an extra special guest, Mr. Carson Herling. And you know, there's an interesting story. I met Carson through his dad. His dad's been a dear friend of mine, and his father was the first person I ever heard on stage say this. He said, "The ultimate in real estate is being the bank." And now the legacy passes on, and you're gonna hear from Carson. You're gonna hear about how this has changed his life, but not just his life, his young family's life. So let me just give you a quick overview of what you're gonna learn. There's essentially three basic things you're gonna learn from tonight. Number one, you're gonna learn how to take back control of your money by being the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses, and it's not gonna require you working harder, working longer, or taking on any additional risks. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. If that's not enough to keep you here, well then, you're riding a bicycle home. All right, so that's enough from me. Let's dive in.
Take back control.
Tuesday?
Well, welcome everybody. This is our normal, every week we do this Take Back Control Tuesday, it is called. Let's make sure we're recording. We're good. All right, everybody. So the money multiplier method is what we're going to hit on today. We're going to talk about infinite banking 101. If that term is new to you, welcome. You're going to learn all about this. You're going to get a lot of new info today. If you know what infinite banking is and you're looking for a deeper dive into it, we're going to give you all kinds of examples, share some stories, and hopefully shed some light on deeper meanings of what this strategy can do for you. And really what we're going to do today is map out the millionaire mystery, we call it. So let's get started here. All right, everybody here. All right, I see a lot of familiar names. Francisco, obviously I know you. I see Frank Whipple here all the time. A lot of familiar names, some new. Guys, today I want to be super interactive. The more you guys are listening, watching, commenting, sharing your thoughts and opinions on things I'm going to talk about, the more you're going to get out of this, the more you're going to learn, the better it's going to be for everybody. So welcome. I'm excited. Please continue to be here. Continue to share in the chat your thoughts and opinions. We're here to accommodate you guys and teach you guys some really cool strategies. And honestly, if you guys are like most Americans, you've probably spent most of your adult life paying banks, creditors, your expenses. And at the same time, you've probably watched a lot of your retirement accounts kind of, evaporate or fluctuate even in the markets. And what we've been taught to do with our money is give up control of it. We've been taught to assume risk on our own part, and it's costing us financial freedom. So today, we're going to talk about a 200-year-old strategy. It's been used by the wealthiest families to eliminate their debts, to minimize taxation, and to really leave a legacy. And I'm going to show you guys how to do this without taking on any more risk, without working any harder, without changing your cash flow even, and without losing control over your finances. And so this presentation today is going to go over and show you guys how you can become the bank and why that even makes sense, why you'd want to become the bank. So let's start with what we're going to talk about today. How many of you guys, here's our first question. Everybody answer up. How many of you at one point or another in your life did not have control over your money? Raise a hand, throw in an exclamation point, comment me, yes. How many of you did not have control over your money at some point in your life? Now, yeah, I get that. How many of you are here today to look for more ways to better control your money and banking in your life? Yeah, I love it. Well, wherever you're at on your financial journey, I welcome you here. And I congratulate you for being here. And I mean that because there's so many people out there that just talk. They just claim they want to do better and be wealthy, but they're not here. They're not saving money. They're not taking action on their financial journey. And the thing that you guys and I today have in common is that we're all here together to learn. And those of you listening, you guys and I, we truly want to build wealth. And so great job for being here. Now, whenever I walk into a room and I speak, or I come on a webinar like this, I always am asking myself, what am I going to get out of today's meeting? And so I want to start with you guys by just sharing exactly what you're going to get out of today, so you know exactly what's going to happen. I have 4 things for you. The 4 things are: first, protection, because who doesn't want to protect the money you earn? The second is going to be tax-free growth, because there's smarter money moves we can make that we're not. The third being leverage, because there are opportunities around us. There are tools we have at our hand that we're not leveraging to the best of our ability. And last is legacy. So what you guys learn here today, I want you guys to take in, soak it in, and then teach those around you. Share this with your family and your friends. So today I have a system that will help you guys accomplish all of these things. If you guys could take home a blueprint from me with these 4 things, would you say that's worth your time today? Heck yeah, it would. Now, I guess for you guys to get a little bit of confidence in your speaker, I'd like to just start really quickly by explaining and introducing myself to you guys. This is my wife and I, Anna. Again, my name's Carson Herleen. We live in Southern California, where we love life. We travel a lot. We do some pretty cool stuff. And over the past few years, I've built a foundation for my young family to not just be rich, but to build generational wealth. And I can sum this whole experience up with 2 words. One being gratitude. Gratitude for the many blessings I've received and the opportunities I've been given. And I'm so grateful that I can feel secure and confident in my financial future. But more than that, I'm grateful. Well, the second word I chose was choices. And I say choices because I get to choose every day what I do. If I want to go to Europe next month with my wife, we can get up and go. I have so much freedom over my finances, and it's bled into my personal life to allow us to do what we want. And my story is pretty simple. I'm sure most of you actually can relate to it. In my early years, I made a lot of mistakes, as we all do, right? And at 18 years old, I went on a service trip where I lived abroad for a year and I served people. Amazing experience. But when I came home, I was in school. I had all these different outside influences pushing me different directions. In one hand, I held the traditional route and mindset. I was kind of being groomed to be good at doing tasks, a good employee, you could say. And in the other hand, I was around investors, people in real estate, business owners, entrepreneurs, and I saw the freedom and control that they had in their lives. And I came to a point that I had to decide. I knew too much. Do I want to keep working for money, a part of the so-called rat race? Do I want to go down that path? Or do I want to learn how to make money work for me? And it was that tension that pulled these 2 places apart that brought me to a point of decision. And that decision was to drop out of school and pursue an education in investing instead, and learning how to make money work for me. That completely changed the course of my life. But above all, what's most important to me is family. I assume similar to you guys. How many of you guys would like to have enough money to spend as much time as you'd like with your family? By the raise of hand or the raise of emoji or comment, whatever you'd like. And I always get this one too. How many of you guys would like to make more money to spend less time with your family? There's always some of you guys too, and that's okay. That's awesome. We want to talk about what you guys want today. What you want is at the center of everything. And so I want to start with statistics, start with some math. You guys are what I like to call the 5%. The 5%, because you guys are here today on this webinar. And if I was to go around and ask 100 18-year-olds, just like myself years ago, and ask them, hey, do you think by the age of 65, around retirement age, you'd be wealthy and successful? I bet you every single one of those 18-year-olds would say, of course I would. There's no doubt in my mind. They'd be so excited about it. They'd say immediately, of course I would be. But something happens from when they're 18 to 65 that changes the whole dynamic. This stat actually blows my mind, but this is what the Social Security Administration said. 5 out of 100 people will be financially secure at retirement age. Now, seriously, think about that. In the United States, the land of opportunity, the great country we live in, how many of you would agree that's wrong? Something has to be wrong. That means 95% of people are going to work until they're 70, 80, maybe taking on 2 jobs, not because they want to, because they have to. Now, before you guys get discouraged and start worrying about your future, I want you guys to know something. You guys being here, you are going to be that 5%, no matter how far or close you are to retirement. And the difference between those people and you is your willingness to invest your time, your money, your effort, and your energy to learn something new. So, who wants to learn some serious 5% stuff today, guys? I want to start with a question. Why aren't more people successful? Why is it just 5%? And guys, I said 5% or 5 out of 100 are financially secure. I didn't say rich or happy or wealthy. I just said secure. That's a terrible stat if only 5% are just secure. So why aren't more people secure and successful? I think it's because of 2 factors. There are wealth killers, and there is a mindset that has to happen for you to become successful. These wealth killers are what we all talk about: taxes, inflation, volatility. This is talked about on the media every day. These things hurt you. You get paid, a portion gets taken out for taxes sent to the government, a portion gets hit with inflation due to the government spending and printing money, and then volatility again because of the fluctuations of the market, craziness in the economy. Over a long period of time, those 3 things are going to destroy your wealth. And mindset, because beyond all of that, if you just follow the status quo, do what everyone else does, well, look, 95% of people don't retire secure financially. So if you follow that status quo, you're going to be a part of that 95%, and most people are. And so if you follow the status quo, you live your life out of fear, and you don't maybe even take risks or try to control your financial future, you're going to be destroyed by these different factors. And of course, life always gets in the way. COVID was not expected by anybody. Things like that happen, and it hurts families, and that's a part of life as well. So how can we build a foundation to build wealth in a safe, predictable, risk-free way? That's what we're going to talk about today. I want to start with a quote by Will Rogers. He says, "The problem in America isn't so much what people don't know. It's what people think they know that just ain't so." A lot of what we've been taught about money may not actually be the truth. So I need you guys to keep an open mind also throughout this webinar. I'm going to challenge the way you guys think about money. So let's dive into it. And I just saw that question, Frenchie. Yes, Greg Curley and I am related to him. We'll talk about that at the end. So let's dive into this. Have you guys ever heard of the backwards bicycle before? I always start with this because it's important. You guys all probably learned how to ride a bike at a young age, but have you ever heard of somebody trying to ride a bike backwards, where instead of you turning the handlebars right, normally the bike goes right, but no, what if the bike went left? What if you turn the handlebars left and the bike went right? You'd have to completely change your mindset around how you ride the bike. And so there was this experiment done. You can look this up on YouTube, the backwards bike experiment. He got up on a bike that was backwards. He took 2 pedals and fell. He couldn't ride it. He did that again over and over and over again for hours on end. Could not figure out how to ride a bike, which we all know how to ride a bike since we were little. Eventually, he got it after hours of retraining his brain of how a bike works. And then he tried to go back to riding a normal bike and couldn't again. He couldn't get on a bike that was normal after that. Eventually, hours of training, he got it down. He could ride a bike again. But I share this with you because when you learn something one way, it's incredibly hard to change. And the same is true for money. Since we were little, we've been trained how to think about money. But what would happen if I told you what you were taught was wrong? It'd be very difficult for you to change to the new way of thinking, wouldn't it? But it wouldn't be impossible. Eventually, you would learn how to ride the backwards bicycle. And this strategy, again, I told you in the very beginning, it's a 200-year-old strategy. I did not make this up. I learned this from Chris Naugle and our team and other people as well. If you guys look out and read business books, read books like Second Chance by Robert Kiyosaki, he mentions this many times throughout his book. He's using this strategy. What about Tony Robbins, Money Master the Game? You guys know this book? He talks all about this in his book. Becoming Your Own Banker by R. Nelson Nash. This book is the foundational book to learn this strategy. And then those of you here, due to Chris Naugle, these 2 books at the bottom were written by him, all about how we use this concept today. And so let's talk about some of the mysteries of money. First off, guys, question for you again, liven up the chat. What is the definition of money? Tell me, what do you guys think this is? But yeah, great answers, everybody. Money, I mean, the way I look at money is this just a means of exchange. Money for food, food for money. Money for car, car for money. Money for house, house for money. Money is just a means of exchange. So what if I was to ask you guys this question? What companies use compound interest? I'm sure you all have heard that Albert Einstein said that the eighth wonder of the world is compound interest. What companies actually use it, do you think? What would you say? Most people say banks or Wall Street, first thing they throw out. But the answer is not one business uses it. Let's focus on banks though, because that's usually the most common answer. Banks don't make compound interest. They charge you compound interest, but they don't use it themselves. Because for example, if I went to Wells Fargo right now with a $20 bill and I handed it to the teller, they're not going to go in the back, put that $20 bill in my storage unit of my name and just store it there. Now they take that $20 bill and they go lend it out to somebody. They go make money on it. There isn't a business in the world that uses compound interest, and nor do banks. Banks keep money in motion just like you should. But you've never been taught or shown how to do that. You've been taught to just park your money and leave it in somebody else's control for decades. But today that has to change. Because again, two more questions. If I was to ask you these, what would you think? Are your dollars worth more today or in the future? And are taxes going to go up or down in the future? Well, think about how many candy bars you could have bought 20 years ago for $1 versus you probably can't even buy one candy bar for $1 today. Your dollar is worth way more today than it will be in the future. And do you think taxes are going to go up or down? They'll probably go up, but if they don't, they'll just find more crap to tax us on. So wouldn't it make more sense to pay tax on the seed versus the harvest? Of course it would. But that's typically not what we do. I bet most of you actually have a 401k or some type of employee-sponsored plan. And what you're actually doing is when you put those dollars in that 401k, you're giving up today's dollar in exchange for weaker dollars later. You're actually compounding the tax because the tax is always going to be there. And when you pay the tax on that money someday later, you're going to pay tax on a larger amount. You won't pay tax on the seed. You're paying tax on the harvest. You're paying tax on a future higher dollar amount. And the funny thing is we've been taught that this is good. We've been taught to give up control of our money. We've been taught to do things with money that we would never actually do with things that money buys, which is funny. Let me give you an example. If you guys went to the grocery store right now, bought a loaf of bread, drove it home, opened up the freezer door, threw it in the freezer, and then you waited 5, 10, 12, 15 years, and then you came back, opened up the freezer door, took out the loaf of bread. Would you guys eat that loaf of bread? Never in a million years. It would be freezer burned. What if you went to the local Ford dealership right now, went and bought a brand new truck, drove it home, all stoked, parked it in the driveway, went in to show your spouse, and then you waited 5, 10, 12, 15 years to drive the car? You would never do that. But that's exactly what we've been taught to do with our money. We've been taught to give up control of our good dollars today that are worth more for weaker, higher tax dollars later. And if you want to be good with your money, you need to start changing who's in control of it. So, what about retirement accounts? Real quick, let's hit on it. When I ask people about the retirement accounts, I can tell you exactly what you're going to say or what you know before you even tell me. I guarantee you, you know very, very little. You probably know whether you're in a conservative, moderate, or high risk tolerance. And you certainly know when you got the last statement whether the balance went up or down. It's probably it. We've been taught to just accept this traditional way of giving up control of our money. But to truly build generational wealth, no one does that. You need to challenge these old concepts and understand how money really works. So, how does money really work? Let's start with a little money quiz. Can you guys make more money earning 4% while paying 6%? Think about that for a second. Kind of weird. Can you make more money earning 4% while paying 6%? Well, the normal naked eye looks at that and says, no, 6 minus 4 is -2. You lose money in that transaction. Well, let's give you a real example. Realistic scenario. Let's say you have $25,000 sitting in your bank account. You have two options. You want to go buy a car for 25 grand cash, pull it out of the savings and go pay for the car. Or you could take a loan from the bank using your 25K sitting there as collateral and then go buy a car with a loan from the bank. Let's say your savings account pays you 4%, amazing high yield savings account, right? And then you get a 6% car loan. Let's just go through those numbers and see what that looks like. Well, in that scenario, a 5-year, 60-month regular old car note at 6%. and you're 25K sitting in your bank account earning 4% during that same time period. Let's look at the math behind this. At 6% for 60 months, your payment is $483. You will spend $28,000 over that 60-month period to pay for the car, extra for interest, right? Well, guess what your bank account ends up being after that 60-month time period? $30,525. Why is that possible? How are you having more in the account earning 4% versus the car note at 6%? The answer is simple. You are compounding interest in your savings account, uninterrupted. It's going to sit there and compound on itself for 5 years. While the interest on your car is being paid down, and it's less and less and less. So eventually it'll just compound over it. So in this scenario, you would have actually made $1,500 in your savings account, more than you would have paid on your car. You would have made money kind of off of buying the car. So yes, indeed, you can make money earning 4% while paying 6%. Anyone thought of this before? Does this make sense? People in the chat? Let's see. Yep. So let's dive into this. What are you all here to learn today? The money multiplier method. Everything I've just discussed the past 15 minutes is just background education, so you guys kind of understand the mindset behind what we're going to do here. Now, what we're going to hit on today is the money multiplier method, which is 3 things. We're going to need a machine to do this. This is going to be a marathon. It's going to take a long time. And the millionaire, this just represents your goal. What are you trying to become? A millionaire, multimillionaire, have more time with your family, start your own business, whatever your goal is, stick that in there. And the money multiplier method is really just our name for infinite banking. And so what I've learned throughout my life of studying money is the more I learn, the more I realize I don't know. And it kind of becomes an ever increasing journey of financial education. There is always something new. And so when I ask this question to you guys, I want you to kind of have the same learning mentality, humble mentality of learning about money that I do and have gained to have. So this question is, could it be possible that there are more efficient environments to store wealth outside of commercial banks that you are not aware of? Genuinely think about that for a second. You ever thought about that? This should be yes. This should be a yes for most of you. This is a powerful question because I want you guys to think about what you're not already thinking about, what you haven't yet been taught. And I hope when it comes to money, we can have a humble learner mentality like I just mentioned. So you guys, I mentioned earlier, Rich Dad, Poor Dad, Tony Robbins, Money Master of the Game, these business books. What do they all talk about in these books? What does everybody say in terms of money management? Everybody says one thing: save money. Usually they say save at least 1/10, save 10% of your income. If you can do that, you're going to be in a good position. I hope most of you save at least 10% of your income. I really do. In today's economy, it's hard, but you should really be trying to do at least that. The average American saves about 5% of their income right now, and it's simply not enough. In our American culture, we don't value savings. We don't value the retention of our dollars and our control. And I think one of the reasons that we don't save money is because of the environments we've been told to store money. These environments like savings accounts, high yield savings accounts, 401ks, they are so incredibly inefficient that it's so hard to save money because the money that we place in these environments, they don't do anything. So what we're going to talk about today is an activity in our life called banking. Banking, if you look it up, is depositing, lending, and protecting money. That's the definition of banking. So if you're going to become your own bank, if you're going to be a good banker, you need to be able to control the depositing, the lending, and the protecting of your own money. And so banking and this verb of how your money moves, the activity of your money moving, is a major paradigm shift for most people to start learning about. But the interesting thing about banking is that it affects every single component of your life. So wouldn't it be smart to learn a little bit about banking and how that actually applies to our life? Once I show you guys this banking world, I guarantee you, you're never going to be able to think about money the same way again. And so let's talk about what your bank's going to be. Remember earlier I mentioned the money multiplier method has a machine, it is a marathon, and the millionaire, just your goal. The machine is what we're going to start with. The machine is is just where your money goes. It's where your money runs through before it goes to work for you. So what is that machine we're going to use? What is the bank you are going to use to be your own bank? Well, if this bank was going to be set up to replace your current savings vehicle, then anytime you ever needed to buy something or invest in something, that's going to come from and to your new bank instead of your old bank. So let's start with just a few attributes of what your bank is. And we're going to compare it to a traditional bank because that's where we're currently saving our money. In our savings accounts, money's liquid, right? That's the entire reason you store money there. It's liquid. That's what it's supposed to do. So the machine you store your money, the bank you run your money through to do this strategy needs to also be liquid. So check, we'll make sure it's liquid. Okay. What if I told you that traditional banks right now pay an average of 0.07% annually on your money sitting there? What if I could tell you your bank was going to make 2 to 6%? What if I told you that was guaranteed? What if I told you that was going to be uninterrupted and compound on itself forever? What if I added on to that and said your bank was going to grow tax-free, whereas the traditional bank's going to be taxable? What if I also added that it was protected against lawsuits, judgments, liens, some states, bankruptcies, divorce? Your bank sitting anywhere else is not protected. And last, stability. What if I could tell you during the most crazy economic times and uncertainty, your money was safe, never to be stopped growing or touched? Whereas money in a 401k, a savings vehicle, crypto could change at any moment. Now, wouldn't this, your bank, be a much more efficient place to store money? This is a place you could control, you could count on, you could use as your foundation to finance everything throughout your life. And I get it too, being in this world, maybe even being a business owner, having a family, having jobs, having life, things are chaotic. So the opportunity to put money somewhere that is guaranteed to grow, still liquid, tax-free, risk-free. And what if I was to add to this, if you did take money out of your bank, you would not stop the compounding. Now, that is something everybody should be diving deeper into. And I mean that. If you are someone who saves money, you should be storing money in your bank, not somebody else's. This is the place you should be running every dollar through. So let's get into what your bank actually is. This machine you're going to run your money through is none other than a dividend-paying whole life insurance policy from a mutual company. And before you guys leave and think I'm just going to sell you life insurance, calm down. What the heck does life insurance actually have to do with building wealth? Well, every rich, elite, wealthy family in the past used it. Why? Well, let's share some people who've done this really quick. Top left, you have Mr. John Rockefeller, massive empire in America. He built his generational wealth. His great-great-grandkids today are still wealthy because of his actions, and he did it through whole life insurance. That's how he passed the wealth down. Walt Disney, on this top right, guess how he started Disneyland when he was broke during the Great Depression and poverty? He started Disneyland from a whole life insurance policy. And these two bottom billionaires in today's world, they have reportedly over $1 billion in whole life insurance. And these two guys on the left, I know we have a new president now, it's Trump. This is a presentation done a while ago. But each of these political figures had whole life insurance. When Biden became president 4 or 5 years ago, his financial statement came out. He had over 4 whole life insurance policies on his bank statement. And you know what's crazy about all of this? These are just a few people. Guess who the number one purchasers of whole life insurance in the world is? The world. None other than banks. If you look this up, BOLI, bank-owned life insurance, you will find that banks own more whole life insurance, not IULs, not VULs, not index anything, not term insurance. They own whole life. They own more whole life than they own in land and buildings combined. So you need to ask yourself, are the banks stupid? Or do they know something that you and I don't know? Guys, it's not a coincidence that just these 4 banks alone have over $60 billion in whole life. They're not stopping buying it either. Guys, they're not stupid. They're smarter than I am, smarter than you are. We just need to mimic what they do. That's how we're going to become our own banks, is just mimic what the banks do. We'll become our own little private bank. So what do banks do? Remember, I told you banks keep money in motion. So how do they do that? Let's say I had $100,000. This could be 10K, 5K, $1,000, whatever you want. Just a simple example, 100K at 4%. Or you have a bank account paying you 4%. You're stoked they pay you a great return. I'll leave my money here with this bank for a long time, right? Everybody following along? Everyone in the chat making sense so far? Yes. Some people in here are asking, will this recording be available for access later? Yes, everybody. This will be on Chris Naugle's YouTube pretty shortly. If you do want me to send you this presentation directly so you don't forget it or miss it somewhere, email me here. I just threw it in the chat. Email me. I will send you this recording and others. And if you do want to head out, you have to head out for something now, please just email me. I'll send you anything you need. Finish this this presentation up for you. Okay. So banks. Let's say you have a bank that you store 100 grand and they're paying you 4%. You're stoked, right? Well, what's that bank going to do? Once you deposit that 100K there, they got to get that money out. They got to lend it somewhere. They got to get that money in motion for themselves. So they're going to lend it. So let's just say your buddy down the street who's buying a house at 7%. That's relative to today's market. And then what's your buddy going to do after he closes on the house? He's going to pay the seller. And what is the seller going to do? Put the money right back in. So then what's the bank going to do when they have the funds back in hand? Right afterwards. Lend it somewhere else. There's somebody who wants a car at 8%. Who's going to pay the car dealership? Who's going to put the money back in the bank? Who's going to lend the money to someone doing a home remodel at 9%? Who's going to pay the contractor? Who's going to put the money back in the bank? And then what if the contractor went to Vegas, blew everything on red, lost it all, is in some debt, has to pay off some credit cards, need a debt consolidation loan at 12%, pays off the credit cards. Where does the credit card companies put the money again? Guys, who's in control of all of these transactions? How much risk is the bank taking on all of these transactions? Very little. While you're making 4, they're making 7. They're making a 3% spread. While you're making 4, they're making 8. They're making a 4% spread. While you're making 4, they're making 9. They're making a 5% spread, and they make an 8% spread on this loan. So if you total all of those up, they're making 20% more than you are every year. So my question for you guys again here in the chat today, how much more are they making than you? If you're making 4, they're making 20. Some would say they're making 16% more. Some would say they're making 20% more, but no. How many times does 4 go into 20? 5 times. So they're making 5 times more than you. They're going to make 500% on your money while it's sitting there. 5% or 500% more than you are every single year. And this is truly what's happening behind walls. If you look up BauerFinancial.com, you will read that banks make between 400 and 1,300% on your money annually. Anytime I go to any big city, any big town, anywhere in the country, guess who has the biggest property, the biggest lot in the nicest corner in town? The banks do. Guys, we're paying for it. So earlier when I told you that banks are the #1 purchasers of these specially designed whole life policies, the thing I asked was, are banks stupid or do they know something we don't know? You probably know now they're not stupid. They know something we don't. They're smart. And banks understand statistics. They understand how to protect and grow wealth. They store it in whole life insurance and then they lend it out. They keep money in motion. Let's just do the same thing. So thus far in this presentation, I've given you a large breakdown of everything we're doing. So the last 15, 20 minutes, I'm going to give you real life examples. I'm going to show you how you can buy a car and get all the money back for the car you ever bought by running it through your bank or financing it through yourself. And paying off debt, I will show you examples of that as well. So let's start with the car. Here's how you can get all the money back for every truck or car you ever buy, drive, or own in your life. Okay. Here's an example of a policy. Now, do not dive deep into these numbers. I will break it down for you in 2 seconds. So just wait a second here. I want to talk about this machine we use to store our money, the bank, the policy. First off, you guys really need to change your mindset about premium. Premium is how much money you're paying into the policy. If you think about normal premiums for car insurance, health insurance, it's a bill, it's an expense. It's not an asset. But life insurance is structured differently. Every deposit you make into the policy is going to have all those attributes I mentioned 5 minutes ago. It's going to be guaranteed to grow, tax-free growth, protected, safe, has a death benefit. It's an appreciating asset. And if it's still liquid, then I look at it as a deposit, not a premium payment. It's a deposit. It's a deposit into my own storage of money. The place I keep my money is just the policy. It has all those attributes, all those amazing growth opportunities and protection opportunities. I want my money stored there. I'm going to look at this as a deposit, not a premium. And some people say, well, I'm too old to get life insurance to do this strategy. Well, I can tell you, you're probably not. I have people that are setting up policies on their brand new babies the second they're born. And I've had people get policies on themselves when they're in their mid 70s. So age does not matter. Obviously, a policy on someone who's 70 versus 10 is going to have a huge difference in a death benefit. You could put in 10 grand every single year into a policy on a 70-year-old and a 10-year-old. The 10-year-old is going to have a much bigger death benefit. But that's not going to affect how much money is available to access, the liquidity, the growth. The banking attributes of this policy are the same. So that's why I say age doesn't matter. Death benefit doesn't really matter either, because I'm not using this policy to get some massive death benefit. I'm using it for banking and storing my money here. And so the death benefit doesn't really matter either. Yes, it's on there, it's important, it's cool, but it's not the main reason we're doing this. So now how can we use this policy I just shared with you and how we look at this policy to buy a car? Here's a simple example. Everybody following thus far, this makes sense? Deborah, you said you're 74, it's too late. It is not too late. Also, remember, I just said you could put a policy on a 10-year-old and it's the same banking attributes as a 70-year-old. So what if you just put a policy on a child or grandchild? It doesn't have to be on you. You could still own the policy, manage it, use it, or it could be on you. It just might have a lower death benefit, and that's fine. So let's dive in to how you could use a policy to buy a car. This person who came to us said, hey, I have 10 grand a year I set aside that I just save. I'd love to put it into a policy instead of my savings account. And in a couple of years, I'm going to need to buy a car. So that's what we modeled. They put in 10 grand a year. And the cash value on the far right, the cash value over here, that is how much liquidity you have access to. So when he puts in 10K in year one, he has access to $5,800. In year two, when he puts 10 grand in, his cash value increases to $12,000 in total now. And then it drops to 4 in the third year because I'm going to show you guys taking out 25K to go buy a car. So in reality, it should be higher than that 4,000 in the cash value available, but it's less because we're buying a car. We're taking 25 out of our policy to go buy a car. So if I was to take 25K as a loan against my policy to go buy a car, I'm financing this myself, then I'm going to pay my policy back as if I would pay any other financer. And a $25,000 car, we could just call it a simple $500 a month payment. And if I'm going to pay a bank loan for 60 months or 5 years, I should pay my car loan I took from myself for 5 years, 60 months. So let's show you doing that. You put in 10 grand a year, you take 25 out in a couple of years to go buy a car, you pay yourself back $500 a month, which is 6 grand a year for 5 years. And let's now just dissect this for a second. Okay. You put in 70K as premiums over that 7-year period. You've also paid back to the policy $6,000 per year, which is 30K over 5 years. So you've really injected into this policy 100K. You've also taken out 25 to go buy the car. So your net injection into the policy is just 75. Okay, so you put in 75 over the 7-year period, but look at your cash value. There's no underline right there, but look at the cash value at year 7, 67K. So you've put in 75, you have access to 67. You have access to 91% of what you've put into this. You put in 75, you had access to 91%. That is 67,000. So you just got back 91 cents of every dollar you put into this. And you have a car fully paid off sitting in your driveway. Usually, if this is your first time hearing this, that makes no sense. So I'm going to say this slower. You've put in 75 over 7 years. You have 67K available to you after that 7-year period. You put in 75, you have access to 67, and you have a car fully paid for sitting in your driveway. I'm going to give you one more example to see if this maybe sums it up or helps you understand this better. But let's say in the 8th year, you want to buy another car. You just want to take another loan from the policy, go do another car. Okay, let's do the same thing. And let's also say you don't want to pay any more premiums into it. Maybe you're at retirement age, you don't have any new income to save, or you just don't want to put any more into this. Well, that's fine. We could do that. So you don't put any more deposits from year 8 to 12. You put 25K, or you take 25K out as a loan to go buy a brand new car now for your spouse. Now, what are you going to do? Pay yourself back, right? Just like you pay anybody else, $500 a month for 60 months, just like anyone. So let's dissect that. Over that new 5-year period, you've paid 0 premiums. You've put 30K into it to repay a loan you've taken from yourself, and you took out 25 to go buy the car. So your net injection into the policy is 5K. But look at the cash value growth from year 7 to 12. It went from 67,000 to 91,000. It increased 23K. Your cash value grew $23,000. Okay? And you put in 5. You put in 5 and your cash value grew 23. You just made money off of buying your car on the second round. And why is that possible? Well, remember the example in the very beginning. Can you make more money earning 4 while paying 6%? That's exactly what you're doing here. Your deposit, 70K over the first 7-year period, that is going to sit here with the insurance company, compound interest, guaranteed, tax-free, forever. And then if you want to tap into the cash value, your liquidity, you take a loan. You take a loan for that cash value at, call it 6%. Now you have all your money compounding for you forever. You take a loan, pay it back. While you're buying something, paying it back, your money's still sitting there compounding. You still have a death benefit while you're doing this. And over a 12-year period, you just bought 2 cars and made money off of it. Pretty cool. There's 3 rules we incorporate when we do this. Rule number 1, pay yourself first. He put 10K a year into his policy, his bank. He didn't give it to somebody else's 401k, another traditional bank. He paid himself. Rule 2, he took a loan and paid himself back with interest. He was an honest banker with himself. You don't want to steal from yourself. You take a loan, pay it back. And the last rule is he recycled and recaptured that money. Because wouldn't you rather that interest be paid back to you instead of somebody else? Right?
You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up.
So if this works for a car, what else does this work for? Everything. Any financing you ever do in your life. That's why this can get really, really fun. Now I'm going to show you an example of someone paying off debt because it's easier to understand, and maybe some of you have debt you want to pay off. This might be a good example for you. This was someone else who came to us and said, hey, I have about 500K in debt. He was a chiropractor. He said, hey, it's going to take me 19 years to pay everything off. I'm going to spend about $5,700 a month for 19 years, and all this will get paid off. Have a few credit cards, a personal loan, a car, a boat, a couple of houses, 500K in debt. Okay. He also said, hey, I save $2,000 a month, about 25 grand a year. Can I put that into a policy first instead of just paying my debt down directly? And we said, heck yeah, that's exactly what you should do. So that's what we did. That's what we're going to show you. He put in 25K to start. He then had access in his policy to 14,000. He then takes the 14 out, pays off the first 2.5 credit cards. Now he's in a better position. But what does he do? What is he going to do now that he no longer has a $161 a month payment for a Discover card and $287 a month for a Lowe's card? He no longer has those credit cards. He paid them off. So what's he going to do with those payments he no longer has to make? He's going to pay himself back. That's how he's going to repay his policy. So now he only pays $5,300 a month on his debt. And he's able to save $448 a month and pays himself back that. So year 2 comes around, puts in 25 grand. His cash value is 16,000. He has access to 16K, which he uses. He also paid himself $448 every month throughout the year. So he has access to $22,000, which he uses to pay down the Nordstrom card, the Wells Fargo card, and the private loan. Now he no longer has payments on those 3 cards, which was $276 a month, $271 a month, and $922 a month. No longer has those payments. So again, guys, what's he gonna do? You should know this by now. I'm beating it to, what's the term? Beating it to the ground? I don't know. But that now is $3,800 a month he's paying on his debt. Still So it's a good chunk of his income. But now he's able to save $1,900 a month. He no longer has to pay any of those payments. He's paying back himself those amounts. Third year comes around, he dumps in 25. He has access to 25 in the policy. He paid himself back $1,900 a month. So 23K he repaid himself. So the total cash available is 48,000, which he then uses again to pay off the next two debts, freeing up those payments, paying himself back more. So let's just sum this up real quick. We talked about this being a marathon takes time. This is not some get-rich-quick scheme that pays off your debt right away or lets you be some crazy investor right away. Like, no, this takes time to build. We need to understand that. But over this past 3-year period for him, he put in 25K a year into his policy. That's 75 grand. He also took out loans against his policy every year. He took out 14 in the first year, about 16 in the second year, and about 25 in the third year. He took out his loans against his policy. So he's taken out 55 over that 3-year period. So my question for you guys is, how much is left in the policy? 75 has gone in, 55 has come out as loans. Keyword loans. You might think it's just the 20K, but no, it is the full $75,000 he put into it. It's still in the policy, still earning interest, still compounding. He took a loan for 55 against his asset, his policy. And he's now paying down debt, financing debt, maybe even consolidating his debt into his own bank, you could say. So let's keep going with this example. 4th year, same thing, pays off most of his condo. 5th year, same thing, pays off his condo, just his house is left. 6th year comes around, and the insurance company came to us and said, hey, he actually can no longer contribute 25K per year. It has to be lowered to 10,000 per year from there on out. Some policies have some restrictions on how much you can put in. This was one of those scenarios. So he only could put in 10K into it. But he said, hey, my business is actually bigger and stronger now. I save another 2 grand a month. Can I set up another policy? Heck yeah, you can. So he put in 10K into his first policy, 25 into his second. He then had access to 13K in his first policy of new cash value and 14K of cash value in his brand new policy, just like the first policy he set up in year 1. He had 54K. He repaid himself throughout the year, and so he had access to 82 grand now, which he used to pay off the house. Guys, it took him 6 years, 6, to become financially free. Instead of 19 years, it took him 6. So for those of you who might not have debt, who might not need a car, could you still benefit from privatized banking? Should you still become your own banker? Oh yeah, you should. This is where the fun begins. I don't have any bad debt. I don't have a new car. I don't have these things I need to do. I'm a real estate investor. I run all my income into policies and into rental properties. It gets really fun to create a legacy that way now. So after your debt's gone, after you don't need new purchases, let's start investing. Let's do all our investments through our policies, through our bank, and it gets way more fun. And just to finish that example though, let's say you continue to pay back your policy what you were going to pay the bank. He had $879 a month for his condo. He had 251 months left. He had $1,200 a month on his mortgage. He had 224 months left. If he kept making those payments and paid them back to himself now instead over that same time period, he would have paid himself back 500 grand. That's 500 grand he would have paid the bank. He's now paying back himself. That's pretty freaking awesome. He is recycling and recapturing his money. Wouldn't you rather that money go back to your pocket than the bank's, right? Of course. So as we wrap up here, everybody, let's start thinking of your questions. Where is this? Here you go. Now that you guys know this, do you think this is meant for you? Well, I believe the answer is yes, no matter where you're at on your financial journey or how old you are, how young you are. If you can do this, yes, I'd strongly recommend it. Guys, if you just continue on the same path that all of us Americans are groomed to follow, we're stealing from not just ourselves and our futures, we're stealing from our kids and our grandkids. We're stealing from that next generation. That's really what we're doing. And here's the thing, it doesn't matter if you make $10 an hour or $10,000 an hour. It doesn't matter. This can work for anybody. And why do wealthy people, wealthy companies, wealthy corporations, banks do this? Because they know and understand how to keep money in their families and control it. We need to break the bonds of financial slavery that we've been put in. If we don't, we're going to continue to be stuck. We're going to continue to be in debt and not have the success or the generational wealth that we want. So when you're doing this strategy, you're just saving money the same way you are now. Just one thing's going to change. You're just going to save it in a whole life policy versus a savings account. And then anytime you ever need to finance something in the future, it comes from your policy, not the bank. That's all you're doing here. I'm not here to manage your investments or pick whatever you do. It's just save money in a better place. That's it. It's super simple. Anyone can do this. And so when I look at infinite banking, it's just a cool term of how we become the bank, an infinite amount of ways. So we're going to make our money work for us when we do this. And if we continue to stay and trade our time for money, we're not going to do anything. We're going to stay in that vicious cycle, and it's going to be hard to get ahead. It's going to be hard to build wealth while we're not working, or while we're not making money work for us. This is a way to also make money work for you because it's going to compound for you forever. So as we wrap up here, let's just hit a couple more things you guys might have missed. Your policy grows tax-free, the death benefits tax-free. You could use the policy even for retirement income. You could use policies to fund policies on your kids, pay for colleges, business startups, anything you do. But really, how do you fund the bank? How do you fund the policy? You could fund it at whatever frequency you want. You have control there. What's the minimum I should do for the policy? Some of you might ask. I would recommend at the bare minimum, you should do at least 10 times your age a month. 10 times your age a month. If you're 50, add a 0, 500. That is to ensure you do enough that this makes sense for you. That is the bare minimum I recommend to do. Whatever you're able to save, that should be what you put into the policy as premium, whether it's 500, 1,000, 5,000 bucks a month. I don't know. It depends on your scenario. The max you can do depends on your scenario. We've had people put millions of dollars into these policies. So it just depends on where you're at. And on top of a premium deposit, you can do a large lump sum to get started. Let's say you want to do 500 bucks a month running into your policy. You want to save that money. And then you're like, hey, I also have 25K sitting in my savings account. Can I dump that into this too? Yes, you can. And you will have access to 60 to 90% of the total premium that you just put into this in the first 30 days. You can use it immediately. You could dump 25K in, have access to 90%, take it out and go do an investment. Go finance something, go pay your taxes. Do whatever you need to do. You're just running your money through your bank first. And when you do take money out of the policy, that is considered a policy loan. So policy loans, just so you guys understand, are guaranteed. The insurance company cannot tell you no. They don't ask for a credit check or an approval or documentation. You ask for a loan, they send you the money. It is legally yours in the contract. They are private as well. They don't go on your credit report, which could be cool, because what if you have a huge DTI, all these credit cards, you could pay all those debts off with your policy, consolidate it, redirect it all to there, and now nothing's in your credit report. Then you're just paying yourself back. And there's no minimums or maximums on your policy loan payments. You pay your policy back however you want. As you saw in my examples, I'm just going to pay my policy back whatever I was doing with the money. If I paid off a debt, free up that payment, pay myself back that same amount. You're in control of how you pay it back. And if you choose not to pay it back for a while, you don't have to. You don't actually ever have to pay your policy back if you don't need. The death benefit can actually pay off the loans at time of passing. So why the money multiplier? Why our company? Because we do this all day long. This is our niche, guys. You could talk to all kinds of insurance agents, financial advisors. None of them will be able to teach you this strategy because they don't know this strategy. We talk to financial advisors who are high up, intelligent people all the time. They have no idea what this is because we're not taught this strategy. We're not taught to use life insurance as a vehicle to store wealth. But this is our niche. This is what we do. And we do not charge anything to you for setting up or teaching you how to do this. We are paid from the insurance companies directly for the business that we bring them. So we're taken care of. I'm never going to manage your policy, invest your money, touch your money. You're not giving it to us. You're giving it to the insurance company. You're getting a policy with a massive 100-year-old financial institution. We are just a third party to help you do this correctly and teach you how to become the bank as we have. And just so you guys know too, I mean, we have, I mean, actually, you know what? We are the largest producers of infinite banking policies in the entire country. We're top 3 as an agency, over 5 insurance companies in the country. We are the largest producers of these type of policies. And I believe that's the case because we have a lot of repeat clients, a lot of referrals, because we treat our clients the right way. We aren't here to just sell you a policy and get you on your way. We want to teach you how to become the bank as we have. And that comes after the policy is set up. And one more thing I want to hit real quick. I mentioned it a little bit earlier, but this gets a lot of attention today. Is an indexed universal life or variable universal life or term insurance infinite banking? You might see this on social media. The answer is no. You cannot use IULs or term policies to do infinite banking. They are actually the highest commission policies, which is why most agents who don't know what they're doing sell them. And they look cool, but you have no idea what the actual product is. They have a different purpose than banking. They might be okay for some people, but it has nothing to do with banking. It's an investment. There's risk. Infinite banking is becoming the bank. It's having a place that's guaranteed to be safe and grow and be available for you, and is the foundation of where all your money goes. You don't want the foundation of your wealth to be a risky, volatile object. That's the whole point of doing this, is to get out of that world. So if you have more questions about that, we can dive deeper into it. But I want to finish here by telling you one thing. We're all going to live, and it's guaranteed we all die. More of it as that sounds. So are we better off with or without this while we're alive? Well, guys, I just showed you a whole kinds of ways to pay for purchases, debts, investments, and get more money while doing it. Yeah, you're better off with this than without while you're alive. And what about if you passed away? Well, if you passed away, your family's going to get a massive death benefit. That's pretty cool. Cherry on top of doing this. If you just stored money in a savings account, they're going to get nothing. So your family's better off with this than without. And lastly, I'll quote Warren Buffett, who said, if poor people would just do what rich people do, they wouldn't be poor anymore. So guys, I value your time, and I'm grateful for you to be here. Please take action on this. This is a strategy I use and have for many years. My family's been doing for decades. This works. Start saving money in a place you control, not somebody else's. Now, you can take action in multiple ways. If this is your first time being here, I'd tell you, learn more. Go read books about this. Go watch more presentations, examples, videos, case studies. Dive deeper into what this means for you. If this is not your first time here, or maybe it is, and you're like, hey, I think I get this. I want to figure out how this can work for me. Schedule time to meet with me. As simple as that. This link, carson.beyourownbanker.com, will send you directly to my calendar. I'll meet with you for free and show you exactly how you can set this up for yourself if it makes sense for you to. And if you're like, hey, I just want more resources, email me. I'll send you anything you want. We have all kinds of videos, hundreds of videos to share with you. I'd recommend to learn this, talk about it with people, talk with us, and find ways to set this up for yourself. Now, I'm going to finish here. We got about 15, 20 minutes to go through questions. So I'm going to stop sharing here, keep the comment section up, and let's go through some questions as we finish up today. Again, thank you guys for being here. Nothing so far. Usually we get a ton of questions. You guys all understand this? I'll give you guys a minute for questions. If you got no questions, cool with me. I see there's some throughout the presentation, so I'll maybe go back and hit those. To start, what is your compounding savings interest rate now? It's a long way to say. What she's asking, what does the insurance company pay in the form of a dividend? What's their dividend rate? What are you earning inside the policy? Right now, most insurance companies are paying about 6%. Now, historically, insurance companies pay around 8 to 9%. These insurance companies we work with have been around for over 100 years, every single one of them. They've been profitable every single year they've been in business, and all of them have been paying dividends forever. Historically, that's around 8 to 9%. Right now, it's around 6. Past few years, it's been closer to 5. Whether it was 5, 6, 7, 8, I could care less. I'd rather get a guaranteed return on my money forever, compounding, than it being a volatile savings vehicle or 401k. And not to mention, this is tax-free. A 6% tax-free gain is equivalent to an 8% or 9%, depending on your tax rate, taxed growth. Someone asked, can you put your bi-monthly income into the policy to repay your policy each month and then take out a loan next month to pay for your bills? You would not want to use your bills for a policy. You would not want to say you make 10 grand a month, you have 7 grand a month of expenses. You want to put 10K in the policy, take 7 out every single month and pay your expenses. It wouldn't make sense to do that, because how are you going to pay your policy back? You can't. You're not freeing up income, making an investment, producing new income. There's no way to do that. Plus, the insurance company probably wouldn't even let you do that, because they would say, why on earth would you put all your income into life insurance? That makes no sense. So what we're talking about is your income's 10, your expenses are 7. What are you doing with that 3 grand a month of cash flow? Let's put that in the policy. Let's save that money in our bank instead of saving it in somebody else's. Remember, we're talking about savings. We're not talking about your expenses. Obviously, make more money, spend less, you're gonna have more cash flow. That's always a good financial principle. Someone asked, any particular kind of whole life insurance? Yes, very, very particular. You cannot get a policy like this from a regular insurance agent. You have to work with somebody who does this. If you were to go to get a normal whole life insurance policy, you would have no cash value, no liquidity for 5, 10 years. It'd be terrible. You'd be able to use it long-term. It'd be awesome. 20 years down the line, you could use it for all kinds of stuff. But this is the reason people like Dave Ramsey say whole life's a scam, because you can't touch it for so long. But we build policies where you have cash value immediately. So yeah, that's much more feasible to use today. Someone asked, could you use equity from a home to finance a policy, to put money into it? You could. You could take your equity on the line of credit, dump it into a policy. It's possible, but then what are you going to do with that equity in the policy? What are you going to use the policy for? Now you took a loan, you're going to have a massive payment on your home, on your heat for no reason. So I mean, it doesn't really make sense. If you have equity in your house and you have an investment opportunity that is awesome, and you're confident in it, and it's going to produce more cash flow than your payment on the HELOC, then yeah, maybe use the line of credit to go make an investment. Sure, maybe that makes sense to run through a policy. Maybe not. It depends on your experience in financial management and what you're doing, the investments you have, the confidence you have in those investments. So you have to make sure you do it right. So yes, you could use the equity in your house. I'm not a huge fan of it unless you know what you're doing. What is the lowest amount of life insurance you can start with? So I would change your question and say, what is the lowest amount of premium I can deposit into a policy? The answer would be 10 times your age a month. If you're 50, add a zero, $500 a month is the minimum I recommend for you to do. Someone said, can I start or open a plan for my daughter? Can kids have these policies? 1,000,000% all day long? Yes, you should get policies on your kids. This is a much more efficient way to store money than a 529 plan or some education fund or whatever it is. I would store every dollar you can for your kid in a policy. Yes, is the answer. And Lucy Lyons, I've seen you on here for months and months. I assume you have policies. If you don't, you need to be setting something up because you've been here for a long time. But you asked, when are those dividends usually paid? Annually. Yes, annually, but it does depend on the insurance company. Some companies pay it throughout the year. It is an annual rate, so say it's 6%. That is the annual return on the dividend, and that will be paid differently depending on the company. Those of you asking, if I see you in the chat asking to meet with me, click this link I just put in the chat. That will send you to my calendar. You can set up time to meet with me. It will be a Zoom call or a call if you want. Call is easy too. Someone said I have a traditional whole life policy. This is not what you're talking about, right? 100%. Go look at your whole life policy statement. I bet you there's no cash value. I bet you put a lot of money in it. I bet there's a big death benefit. I'm sure, I mean, I'm not bashing on whole life. Whole life is great. But in terms of like being able to go buy a car next year, like I just showed you an example to do, you probably can't do that. You'd have to let that policy build and season for many, many years before you could probably do that. Whereas a policy like we're talking about, you'd have access to money day one, which would allow you to start doing stuff very soon. Not many more questions. I see some people asked for the link to this presentation. I will be sending that to you guys. Those of you who would like to meet, have a one-on-one call, please schedule on that link at the bottom. Everybody else, have a great week. Happy holidays. I hope we see you here next week. We do webinars every single day, so please keep coming on here, keep learning. Talk to you soon.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.